how to print money without causing inflation. So, one of the things which we know for sure is that printing more money will cause inflation. Just Economics 101. Printing money results in more supply of money, which lowers the real value of currency, leading to price hikes. This means that flushing the economy with more money has always led to inflation, right? Well, not quite so. Printing money does not always lead to inflation, as we will discover in this video. So, stay tuned to find out how more money can be circulated without the disastrous consequences of hyperinflation. But before we continue, I would request you to subscribe to the channel. Thank you. Okay, I'm sure by now you must be wondering how this is possible, so let's start with a real-life scenario. London during the pandemic. In areas like Hampstead, a 1,000 square feet house would cost close to 1.5 million GBP, and it would go for a rent of about 3,000 GBP. This would make the gross rental yield somewhere near 1.7% after accounting for maintenance and taxes. Due to the pandemic and the fiscal policies of Bank of England, financing costs are way less than the rental incomes, due to which the cash flow of property owners has become positive. This means that buying a property would be cheaper than renting it. Why? Potential buyers were depending on inflation to help reduce the debt over time. Again, this goes against established wisdom. Monetary and fiscal policies of the previous year should have led to more inflation, which should have led to an increase in income and real asset valuations. But the loan is the same and actually is coming down in real terms. This proves that more money printing does not always lead to inflation. Keen studies of economics and history would point out that this is simply wrong, and this is precisely what happened in the Weimar Republic before World War II. The German government at the time had to print more money to pay off its war damages in the form of reparations, which then led to hyperinflation. In the end, people had to give a ridiculous amount of cash just to get a loaf of bread. People used to burn money just so they didn't die of the cold, because money had lost its value. The Germans had taken their lesson seriously, and to this day, do not think about flushing their economy with money. However, printing money in the form of 0% interest does not always cause runaway inflation. Let's talk about examples where this has happened. Central banks in Europe and the US. And if money printing trends are anything to go by, it shows that you can get away with excessive printing. Sweden is a great case study to back this case. For years it kept interest rates below zero, but despite that and its circulation of money, inflation varies between 1.7 and 1.9%. By traditional metrics, Sweden should have become Zimbabwe by now, where people actually slept over beds made of cash. The evidence coming from the UK central bank also seems to support this assertion. When the inflation in the UK started to go up to 3%, the BOE started thinking about increasing the interest rate to combat the inflation. BOE interest rates have been zero since the crash of 2008. The target inflation rate of the BOE is about 2%, and the optimum way to bring it down would be to reduce the supply of money. But as things stand today, BOE did not raise the interest levels because their money printing does not cause runaway inflation in the first place. The devaluation of the GBP is largely a function of what happened due to Brexit. In a high inflation economy, you also will definitely see a high wage growth as the economy continues to expand and people demand higher salaries and wages. But again in the UK, this has not been the case since wages in Britain have not increased as much. The situation with wages is so severe that it resulted in a major vote shift towards the Labour Party. Although the Conservative Party is ruling the UK, their vote margin has drastically shrunk. Employment figures are pretty good, but despite that, British workers do not have the extra leverage to demand more money. In their case, increasing the interest rates may only damage the economy more. It will lead to more expensive consumer debt, which will eventually end up damaging the employees and hurl the economy into a stagflation type of situation, which is a stagnant economic period marked by rising inflation due to a pound, which is losing its value. There is a counter-argument to be made. Inflation has struck the British economy. Housing prices have skyrocketed, but the inflation was funneled into investment assets, not into consumer product prices. Much of the blow was, however, softened by the combined effect of technology, the internet, and the sci-gig economy. Increasing consumer prices would hurt workers really badly, but this has not been the case, since people can actively scour the internet for the cheapest possible commodity. This has been called the Spotify effect, which means that while previous consumers would spend so much more money on something, say music, by buying CDs or vinyls, now they can have a subscription which gives them music more flexibly. The same argument can be made for buying movies or getting a subscription with Netflix or Max. But things have not been great for wage-driven labor because of this. Most of the software-based companies such as Facebook, Twitter, and Uber have cut down their workforce like a whim. This has allowed these companies to keep their wages down. Since more people are self-employed than ever before, their demands for higher wages are kept in check by these companies. Enough about the UK. Let's talk about the central bank expansion, money supply, and inflation in Japan. Japan has a lot to teach us about the relationship between money supply and inflation. Due to the poor performance of the Japanese economy in 1990, the Japanese government has been actively experimenting in their economy. The economic goals have been the same: to create moderate levels of inflation and foster positive economic growth. Now, when we look at the 10-year rolling returns of their balance sheets, money supply, and inflation, we can see that the Bank of Japan's balance sheet has increased by multiple times since 2008, and that this activity has little to no impact on inflation. This ultimately means that although money supply and inflation seem to be correlated many times, this was not always the case. Economics tells us that inflation should immediately follow after money supply, which means the more money in the economy, the more demand we generate, which leads to higher prices. But the economy does not always work in such a linear fashion, which is why reality is so much different from these predicted linear economic models. The same argument made for the Bank of Japan could also be extended to the Federal Reserve Bank. In fact, in the case of the US, we can also see the opposite. The inflation can sometimes take place without meaningful changes in the money side of things. The economic crisis caused by the oil embargo in the 70s. Some key investors are talking about the economic recession, which is set to hit the US economy because we have already hit the peak of inflation. Only time will tell us if and when this will happen. Theoretically, money supply can be increased without causing inflation when the growth of real output is the same as the growth of the money supply. This seems to be relatively straightforward. The second case is when bank reserve ratios are increased. Historically, this happened when the Federal Reserve increased the monetary base by more than 120% inflation at the time. The third case is when the money supply is hard to measure. This can be true if the economy is not properly documented, which is usually the case for many third world countries. Brings our present video to a conclusion. Hope you enjoyed this video. Please give this video a thumbs up. Thanks for watching till the end. See you in the next one. Cheers!